Good morning, everyone. Today, we're navigating a crucial decision for your financial future, the growth dilemma. We'll explore the choice between the NASDAQ 100's velocity, represented by the innovator, and the S&P 500's stability, the standard, as you chart your course towards financial independence and a secure retirement. We'll dive into asset performance, market psychology, and crucial retirement strategies, using some familiar analogies to make complex ideas clear. Think of it as choosing the right engine for your journey. Let's start by looking under the hood and choosing your engine. On one side, we have the innovator, embodied by the QQQ ETF, tracking the NASDAQ 100. This engine is composed of the 100 largest non-financial companies, with a significant tilt towards technology and communication services. Its philosophy is all about the future, engineered for high alpha, meaning outperformance, but it comes with a higher beta, indicating more volatility. On the other side, the standard is the SPY ETF, which mirrors the S&P 500. This is a broader, more diversified engine with 5-year-3 companies across all major U.S. sectors, including financials, healthcare, and industrials. Its philosophy is the market, engineered for diversified stability with a lower expense ratio. The key insight here is simple QQ is designed to beat the market, while SPY is designed to be the market. Which engine best suits your drive? Now, let's look at the tail of the tape historical track performance. Over the past 5, 10, and 15 years, QQQ has shown a higher compound annual growth rate, or CAGR, significantly outpacing SPY. For instance, a $10,000 investment in QQQ 10 years ago would have grown to over $103,000, compared to around $29,000 with SPY. However, it's not all about raw growth. SPY generally offers a higher dividend yield, which can be important for income-focused investors, and it has a lower expense ratio, meaning you pay less for the ride. It's vital to remember this crucial caveat: past performance is an indicator, not a guarantee. QQ, with its higher growth potential, also suffers deeper drawdowns during market downturns, meaning more significant temporary losses. It's a faster engine, but sometimes it takes a harder hit. Diving deeper under the hood, let's examine the concentration factor. Both SPY and QQQ hold many of the same high-performance parts, particularly the Magnificent Seven tech giants like Apple, Microsoft, and Nvidia. However, the weighting of these giants differs significantly. Nvidia, Microsoft, and Apple alone comprise about 25.5% of QQ, while they make up a smaller, though still substantial, 20.7% of SPY. This means QQQ is a more concentrated bet on the top end of the market. The implication is clear: when big tech catches a cold, QQQ gets the flu. The question then becomes, does QQQ's tech-focused growth outweigh SPY's stability for you? The answer depends on your comfort level with that higher beta, that greater volatility. A common concern today is whether we're in a bubble, similar to the dot-com era. Let's assess the terrain. When we compare the tech leaders of 2000, companies like Cisco, Intel, and Oracle, to today's Magnificent Seven, we see significant differences. In 2000, valuations were sky-high with a PE ratio of 52x, net margins were lower at 16%, and cash reserves were quite low at 1.7%. This indicated high risk. Fast forward to 2024, the Magnificent Seven, including Apple, Nvidia, and Microsoft, boast a more moderate PE of 23.9x, significantly higher net margins at 28%, and strong cash reserves of 4.2%. The verdict is clear. Unlike the speculative valuations of 2000, today's AI-driven rally is backed by stronger balance sheets and nearly double the profit margins. This suggests a more bedrock foundation rather than a fleeting bubble. The allure of the lottery ticket can be strong, especially when we see headlines about extraordinary gains. Let's look at the what-if machine. $1,000 invested 10 years ago. Bitcoin would have exploded to over $237,000, Nvidia to nearly $146,000, and even Tesla, a volatile star, to $25,000, dwarfing the market average. These numbers are exciting, but here's a crucial reality check. While these figures dwarf typical ETF returns, they suffer from survivorship bias. For every Nvidia that rockets upward, there are dozens of companies that stagnated, went bankrupt, or delisted entirely. Relying solely on hindsight and chasing these speculative wins is a dangerous strategy for long-term financial planning and securing your retirement. It's important to remember that such extreme outcomes are the exception, not the rule. Let's examine the current landscape of winners and losers. In 2025, we've seen semiconductors like Micron and Nvidia continue to soar. Geopolitics have fueled aerospace and defense, with GE Aerospace showing strong gains. Banks and financials have also posted double-digit gains, benefiting from interest rate movements. Even Alphabet, Google's parent company, has shown strong recovery thanks to AI redemption. However, it's not all growth. Non-AI software companies like Salesforce and Adobe have seen declines, indicating capital rotation out of some areas. Real estate, particularly REITs, has faced pressure from borrowing costs. The insight here is crucial. While QQQ investors enjoyed the tech rally, SPY investors captured gains in banks and defense sectors that QQQ missed. Market leadership shifts and broad diversification helps you catch the unexpected winners, offering a smoother ride. Now, let's talk about the driver's mind. There's a critical difference between sound investing, speculation, and what we call pathological trading. Investing is rational and long-term, aiming for positive expected returns with a low frequency of activity. Speculation has a variable time frame and mixed utility, often with higher risk. Pathological trading, however, is addictive and compulsive. It disrupts personal functioning and leads to negative expected returns. The trap lies in how modern apps are designed. They often use variable rewards to trigger dopamine releases, blurring the line between building genuine wealth and chasing a high. It's vital to recognize this distinction for a healthy financial journey. Think of your financial journey like driving a car. There are warning lights on the dashboard that indicate trouble. Are you chasing losses? Trying to win back money by increasing risk? Do you need bigger trades to feel the same excitement, indicating a tolerance developing? Are you preoccupied with markets 247, even during family time? Do you trade to escape anxiety or bad moods, using it for distress relief? If you check these boxes, you're not driving strategically, you're gambling. The cost of such behavior is high excessive transaction fees, tax inefficiency, and emotional burnout. It's crucial to heed these warning lights to protect your financial and personal well-being. Our ultimate destination is often retirement, and this requires shifting gears from the paycheck economy of accumulation to the portfolio economy of decumulation. During accumulation, a market drop can be seen as a buying opportunity. But in retirement, a market drop becomes a serious threat to your survival. You face several significant risks: longevity risk, as retirement can last 30 or even more years; inflation, which constantly erodes your purchasing power, meaning what $45,000 buys today won't buy the same goods years from now; and volatility, because you no longer have a salary to buffer those market losses. As the quote says, you need a big enough nest egg to meet income needs over an extended period, and you don't have the luxury of time for investments to recover from a major downturn. One of the most significant hazards in retirement is sequence of returns risk. This shows how the timing of market returns can drastically impact your portfolio's longevity, even if the long-term average return is positive. Consider the lucky start, retiring into a bull market where your portfolio grows initially. This can allow your money to last 40+ years. Now, contrast that with the unlucky start, retiring into a bear market. Selling low early on to cover expenses depletes your assets permanently and can dramatically shorten your portfolio's lifespan. The 5 years before and after retirement are what we call the red zone. A significant market crash during this period can destroy even a well-planned retirement, because you simply don't have time for your investments to recover before you need to draw on them. To help manage those risks, consider applying the parking brake with the 4% rule. This decumulation strategy is a guideline designed to help your retirement savings last for 30 years, based on historical worst-case scenarios. Here's how it works. Step 1. In your first year of retirement, you withdraw 4% of your total portfolio value. Step 2. In subsequent years, you increase that dollar amount by the annual inflation rate, which maintains your purchasing power. There's a debate around the 4% rule. Optimists believe 4% is modest, and many end up dying with wealth left over. However, conservatives, especially those retiring early, suggest a 3% rate might be safer given lower bond yields. Crucially, the 4% rule is a guideline, not a law. It acts as a governor, forcing discipline on your withdrawals. To further fortify your retirement strategy, consider employing the 3-bucket approach. This method divides your retirement assets into different time horizons and risk profiles. The first bucket is liquidity, covering years 1 to 5. This holds cash, CDs, and short-term bonds, providing immunity from market crashes and allowing you to sleep well at night, knowing your immediate expenses are covered. The second bucket is lifestyle, for years 3 to 10. This contains a balanced growth portfolio, perhaps a mix of SPY and bonds, designed to replenish your liquidity bucket and keep pace with inflation. The third bucket is legacy, for years 10 and beyond. This is your high-growth bucket, perhaps including QQQ and other equities. The key is that these long-term assets are never sold during a market crash. They wait for recovery, ensuring your future growth while your nearer-term needs are protected. Maintaining your portfolio effectively also means focusing on tax efficiency and logistics. First, maximize tax-advantaged accounts like IRAs and 401ks. These accounts shelter your growth from annual taxes, allowing your money to compound more effectively over time. Second, understand loss harvesting. This strategy allows you to offset capital gains with losses. For example, realizing a $2,000 loss on one stock can reduce the tax bill on a $5,000 gain in another. Third, don't forget foreign tax credits. If you hold international investments that pay dividends, you can often claim credits for foreign withholding taxes, avoiding double taxation. Tax laws change, so always consult a specialist for advice tailored to your specific jurisdiction. In conclusion, the final verdict on your investment strategy truly depends on your investor profile and stage of life. If you're an aggressive young accumulator with growth as your priority, your vehicle might tilt toward QQQ, the NASDAQ 100. Your driver instructions are to accept volatility, avoid pathological trading behaviors we discussed, and focus on generational growth. However, if you're a conservative retired accumulator with stability as your priority, your vehicle might be SPY, the S&P 500, or dividend growth stocks. Your driver instructions are to prioritize stability, use a bucket strategy to mitigate sequence of returns risk, and remember this key takeaway. The best vehicle isn't the one that goes the fastest. It's the one you can drive comfortably for 30 years without crashing. Choose wisely for your unique journey.